So better than expected economic data here and abroad helped push the markets up, but does this rally really have legs?
Well, let's ask our market panel. Joining us now is John Manley, Wells Fargo Chief Equity Strategist. And in the pits of the CME, we've got Scott Bauer, Trading Advantage Senior Market Strategist. Hey, guys.
Hello. How are you?
So what do you make of this rally today? Why didn't we hold the highs of the session? And what's this manufacturing report? Okay, so we're not shrinking anymore, but is it really a good report? Reason to cheer?
Better than not. It was up, not down. It was 51, not 49. That's not the greatest in the world, but it's better than it was. So I think, on balance, today was a microcosm of what investors face. The Fed has said they're willing to do anything that has to be done, but that implies that probably something will have to be done.
John, you say the market reminds you of the 1980s. Now, we had real growth in the 1980s. We don't have real growth right now. In what way does it remind you of the 1980s, John?
Well, very early in the 1980s, 80, 81, when the market was dealing with some real issues, the bond market vigilantes forced their will on the policymakers, and I think that's happening that's why it's like that. We'll get the growth after it's done.
Hey, Scott, can we ignore what's happening globally? Manufacturing in China, in the UK, in France. Manufacturing in France is like the same as Greece right now. Can we ignore that?
Well, let's look, like you said, let's start in China. Just a couple weeks ago, we spoke about it right here. We saw the Chinese market drop 5% in a week, and it wasn't even a blip on the radar screen here. So last night we see this news come out. Their manufacturing number is not great, but better than expected. So that was positive news coming in here. I think what you're seeing in Europe, in France, we're going to see the same thing. They're not good numbers, but we know that there's just this almost endless support that we're seeing here. So we shrug off the not so good numbers, we rally on the good numbers, and that's the mojo behind the market right now. Anything that's negative, we see, or the traders and the public sees that there's still going to be support. This QE3, this endless QE3, we're going to plop up the market. So the focus right now is on anything that's good propels this market. Now, also with the news that came out,
Scott, let me just stop you for a second, Scott, because the market did pair some of its gains around the time that Ben Bernanke was speaking. I don't think it was a coincidence. We were watching the market activity while he was speaking. It did go down in relation to what he was saying. What was it that he was saying that kind of put a damper in the market?
Well, I think he tempered the big gain with the Dow being up 120 on the ISM news this morning. I think he tempered it by saying, you know what, folks, things aren't so great. Things maybe in the real near term, we're not getting that much better, but at the end of the day, we're still there. We're still going to support this thing, and it's going to keep going on. So, so of course we gave some of it back, but to come out of the gate this morning when that ISM number came out, which in and of itself, not a great number, better than expected, does show, like you said earlier, some expansion. Not a tremendous number, though, but people took that and they ran with it.
Let's bring in John here for a second. But then Ben Bernanke goes on to say that he's not going to pull out of supporting the market prematurely. So how long is this Fed boosting of the economy going to continue?
How long does it have to continue? And I think what Dr. Bernanke has said is that if he makes any mistake in the next 2 or 3 years, it's that he was too stimulative. He kept rates too low for too long. He doesn't want to make the other mistake, and the market can take some sort of comfort from that.
So is inflation a problem with all of this?
When I'm a lot older.
But you must be concerned about the low growth. I mean, John, we have this anemic growth. It just keeps getting slower and slower. With every QE, it tends to have less of a punch than it did with the previous QE. Doesn't that concern you, the fact that eventually corporations aren't going to have any revenue at all if we keep going at this rate?
Well, they won't have any revenue growth, but they still seem to be deliver profits that really aren't that bad. I think.
But hold on a second, because a lot of that has to do with the bottom line. A lot of that has to do with them cutting costs. They're laying off workers still like crazy. That's where our unemployment rate is as high as it is. It's not necessarily because of increased revenue, and that's because the economy is slowing. The GDP is going down.
Well, it doesn't always have to be because of increased revenue. Cost cutting does mean something. When higher revenues come, you have more efficiency. There's more money around for everybody at that point in time. This is the way you get there.
John, reading notes on the segment today, and you're actually pretty bullish on Europe right now. Can you tell us where in Europe and why?
Well, actually, we're just sort of edging back into the foreign markets. We've been pretty much recommending that people be out of them for the last year or so. We're using consumer staples as sort of a substitute here in the U.S., the multinationals. I just think Europe and Asia are down so much versus the U.S. in the last 12 months. At some point in time, gradually, that stimulus in China begins to work, and all the discipline the Europeans have shown begins to work for them. I think it's sooner rather than later, and there's no magic bell that gets wrong like the end of the day here on Wall Street. You just start to move towards it, and that's what we're suggesting.
And Scott, little hint of the day, little commodity hint between the split between silver, which is doing spectacular today, and gold. You think that indicates a buy on gold? Why?
I really do. If you look at the gold-silver ratio, especially over the last 9 to 12 months, we are at a very critical support level, right around 50, meaning gold's trading about 50 times more expensive than silver is. That's a support level. This range has been 50 to 59 over the last year. That is a signal to me right now, if I were to get into that space, that I would probably be a buyer of gold, but versus shorting silver. Not just buying gold because it's going up, on its own, but versus silver. Now, that ratio hasn't been this low since about a year and a half ago, when it was down to almost historic lows in the mid-30s. Since then, it's settled in. It's back at this 50 to 59 level, trading down at that bottom 50 number right now. That's going to be a real interesting space to look at over the next coming months.
All right, John Manley, thank you very much. Scott, we're going to be checking in with you in just a couple of minutes to see how the S&P